Ladies and gentlemen, welcome to Creating Tailwinds Podcast by FlightPath Financial with your hosts, John Urbick and Jared Adams. Join us today as we discuss the power of infinite banking. And here we go.
Hey, John, welcome back. Episode 4. We're cruising along here.
Excellent, Jared.
Plugging along. We're at 350. We're just watching the world go by. We do not have a USA Today or any articles in front of us. We're actually paying attention to the instruments. We're doing as we're supposed to.
Absolutely. We are professional aviators, and we do it the right way.
That's right.
Absolutely, Jared.
That's right. Episode 4, creating the entity. We'll get into that here in a second. I heard you had kind of a funny story here recently with downtown Atlanta and where you were parked. Do you want to share part of that?
Oh, you're not going to believe this. I couldn't believe it. It's going to sound funny even to tell you. Have you ever been booted before with your car, Jared?
It's been a long time. I used to go to Georgia State University, downtown Atlanta. I know I've been booted a time or two before. But when you're 19 years old and you can barely afford to have ramen, you barely are able to get those payments made. Like, I got to go ask mom for $100 so that I can pay that guy to get my card unbooted.
Well, I was downtown, and it was late at night. I stopped in because I wanted to have a shepherd's pie at this place called Photos. Whatever. That
sounds fantastic.
It is fantastic. A big shout out to those people. They make great food. But anyway, I parked, and it's a library parking lot next to it, and there's no signs. You pull in, and I ate, and I came out 10 o'clock at night, and my car's booted.
Oh, no.
And I see this guy walking up with a big smile on his face and said, it'll be $75. I said, what? I said, and I look, and my car's booted. I said, take that thing off my car. And I go, you can't boot my car. He goes, you're illegally parked. And we had a back and forth, let's just say, and he refused to take it off my car. And so he goes, I'm going to just come back later. It's cold outside. My car's booted. I still have a 40-minute drive to go home. So I said, here, all right, let's just get this thing done. I'll argue with them later on. So I pull out my credit card to give this pirate some money, and he's going to leave.
Right.
He's just going to leave me in the parking lot booted. And I said, that's not going to happen. So I stood in front of his car. You know what he did?
No, he didn't.
He hit me. He accelerated into me. And back in December, I had knee surgery. I had my meniscus done. It hurt like...
Oh, goodness.
It was really painful. And I'm hobbling along going, I cannot believe this guy just hit me with his car. Police show up. Ladies, three girls see it. They file a police report with me. I mean, it's the craziest thing I've ever seen. But
well, we'll know what the outcome was when we're driving through downtown Atlanta and we see on the side of a truck John Urbick's Tow Company, because you might own them sometime soon.
Honest to goodness, I don't know what I'm going to do about that. But it was bad. If you ever get booted in Atlanta, it's a racket. It is just a racket.
1 star. Do not recommend.
Do not recommend. But the food at that other place, Photos, was awesome. That is good. Worth doing.
That's awesome.
But anyway.
What's our topic? Creating the entity.
Yeah. Creating the entity. Let's talk about, up to this point, we talked about, infinite banking and what it was. Well, I think in this podcast, let's talk a little bit about how you set that thing up.
Sure.
We talk about the different, on a line, all the way from a single pay policy all the way to a term. There's different kinds of life insurance, but the appropriate kind of life insurance, really, according to Nelson, the only kind of life insurance that you should be looking at with a certified practitioner to build one of these things is
properly structured, dividend-paying, whole life insurance
contract.
So we're not shy about what we're using as the entity.
Exactly, and it's got to be an A-rated company with a history of paying dividends, and the ones we've got are well over 100 and 130 years.
Look up the Comdex scores if you're unsure about the company, right? And so not shying away from that sets you apart already from different folks that are. We've already talked about. This is not an investment. This is a concept.
Right.
So sorry, I'm backing up into some of the stuff we've already talked about and brought into that, just to reemphasize.
No, it's all good. I mean, when we look at our life expectancy, right?
Yep.
And Nelson always would talk about the need for capital, the need for capitalization and financing is when we're living now. And we can do something about that. Rather than get into the racket of constantly paying interest to other entities, other people, what infinite banking does is it's a process that builds a warehouse of wealth, a place where you can put your capital that will grow in spite of everything, and you have access to it when you need it.
Right.
So, when you when you look at, 1937, I think it was, when they came out with the earlier mortality tables, people lived to 61 years old.
Sure.
How old are people living to today, Jared?
Easily into their 80s.
Yeah. I mean, if you take care of
Sometimes even
yourself.
way beyond that.
Oh my gosh, yeah, you take care of yourself. Centurions, right? Over the next, I was reading from today, looking out to 2054, which isn't that long out, that they're expecting a quadrupling of centurions. Oh my gosh, if you
That's the same crowd as the millennials, the folks that were in that age.
Yeah.
Yeah.
I mean, my gosh, you're going to live a long time if
Sure.
you take care of yourself,
Right.
all things being equal.
Right.
So say somebody starts working at 20 years old and they retire at 65. They got my gosh, another 35 years in retirement. Sure. How are you going to pay for that?
Right.
I don't care about the death benefit at that point. I care about the life benefit. We can show people how they can address that.
Yep.
They can do something about taxes, and they can do something about inflation, which is coming. It probably is going to get worse before it gets better. But we have a solution that, to my knowledge, nobody else has. This is awesome stuff.
Yeah. It kind of reminds me of a conversation I had in the workplace recently where somebody said, they were all up in arms about the S&P or the Dow losing 1.6% a day, right?
Yeah.
I don't mean to sound arrogant or braggart, but I didn't care at all because I know where my capital's going.
Yeah.
And I know that it's going to gain an uninterrupted compound interest. And I know that I've got access to it. So I didn't say that to the person,
right?
But they were in agony. They're not far from retirement. They're less than 5 years from retirement. Yeah. They've got a great sum built up into their 401k.
Right.
And they probably lost 20 grand overnight.
Yeah.
And so you're like, what do you do with that?
Yeah. So they lose the 20 grand and they still got to pay taxes on the money that they made.
Correct.
It's not great. And people, so many people, Jared, don't understand, or they're not wrapping their minds around the fact that they have a huge tax bill due. I mean, how would you feel if at the beginning of the year you said, look, I'm not going to put anything aside for taxes, nothing. I'm just going to show up on April 15th. Let's see what it looks like.
Yep.
And say you made $100,000, $200,000, and now you're going to get a tax bill for $30,000 or $60,000, and you're going, ugh, where's the money coming from?
Right.
How are they going to pay that?
Sure.
Infinite banking, that is a non-issue.
Yep.
Pretty cool.
Pretty cool. Sorry, to get us back to the creating the entity piece, the one concept that Nelson mentions real early on is he said 1,000 of the 1,000 people that are born, 1,000 of them are going to die. Right? There's no, everybody here is going to graduate.
Yes.
And I hate to go down a morbid path and try to go down a morbidity path like that, but 1,000 people are going to be born and 1,000 people are guaranteed to die. Where that happens in the middle, who knows?
In the military, they used to call, when you're flying an airplane, a PK, probability of kill when you're in combat.
Yep.
A PK of 1 is you're done. You have been eliminated. Mm-hmm. You drive an airplane into the ground, that's a PK of 1.
PK of 1.
So it kind of goes in line with what you're talking about.
It's not wrong. But we use that as a launching point to say, just like you said earlier, you said the need for capital is greater while you're alive than your need for death benefit.
Yes.
Why not build them both in a vehicle of which you can have access to your capital while knowing that at the end of that, you're guaranteed a death benefit. Yeah. I know we're going to talk about term here in a part of the podcast, but if you set that up as a 20, 30-year term, whatever it may be, and you don't graduate in that time frame, that's lost funds.
Right.
It's gone.
Right.
You will not be able to capitalize those funds.
And it's exciting to open up a statement from the insurance company, your annual statement. You rip that thing open and you look, cripes, I did 5% on that money. And it's a decent number.
Right.
Versus look at my bank statement from Bank of Main Street and it's 0.0 nothing. I mean, it's meaningful. And that money is tax-free. Rolled back in, bought you more death benefit, more cash value, and that thing can't help but grow. And so you're looking down the horizon 5 years, 10 years, seeing this corpus grow, going, this stuff works. And I can tell you, I'm here to tell you that it does work.
Sure.
So.
Yep, pretty cool.
Very cool.
So the creating the entity discussion, that kind of goes, and Nelson kind of builds up this teeter-totter or this fulcrum.
The fulcrum.
Yep.
Yeah. It's a trade-off between death benefit and cash value. Is that where we're going?
Exactly.
Okay.
How would you describe that? How would you describe the trade-off between the death benefit and the cash value, and how that sits on the fulcrum like a teeter-totter in the middle?
Right. This is something that a lot of people who get into infinite banking, creating their own bank, lose sight of. They think it's all about the maximum amount of cash value on day one into a contract. That is nice. That is an objective. However,
That's a plus.
it's a plus.
Yep.
But this is a teeter-totter, as you just said. You can take one or more of the other and invert them. So if I want more death benefit, I can have it, but it's going to come at the cost of cash value initially.
Yes.
Conversely, if I'm building an IBC-style account, I want to maximize my cash value, and that is going to come at the expense of death benefit. So Nelson would say, look, don't gun for maximum dollars in. He goes, this is a process. You don't do this in one fell swoop. It's the maximum amount of cash for the least amount of death benefit. That's how he put it.
So it's a slow building process.
It is.
This is not a get rich quick scheme. This is a slow, arduous process where you have control of your capital, but you're also growing it. You're building the business of IBC.
I wouldn't even say arduous, because arduous it kind of suggests that it's hard. That's fair. This is not hard. Arduous comes from the Latin meaning hard. You ask me how I know that, 6 years of Latin. But you're exactly right, Jared.
Spot on.
You're gonna build these things as Nelson would say, well, when's the right time to add another contract? Well, the right time is when I have surplus cash on the sidelines and I don't have a place for it but to stick it into a Bank of Main Street. I don't want to do that.
So your policy loans are paid up, your premiums are paid, and you're still building additional capital into the Bank of Main Street account. Yep. That's when you would consider an additional policy.
Exactly right.
Yep.
And, so we talk about, what do you do if you can't, I don't know if we're going to get into this later on, but, what if you're not insurable? I guess we can cover that one later on.
Sure.
Yep. Because there's...
Great question.
There's options for sure there.
Yep.
If you're... all you need is an insurable interest to build one of these things. That means your spouse, your kids, a business partner, another family member who relies on you. There's a lot of different ways of doing this. And all you need is that life. And there's 3 components to these life insurance contracts. Jared, tell us about them.
So the 3 components are, you have the owner, the person who's paying the bill, the life that is protected, and then the beneficiary.
Right.
So between those 3, that's what's going to make up each one of these accounts. As if to say, it doesn't have to be my life that I'm protecting. Maybe I'm the one paying and maybe I'm the beneficiary of it, but my wife's life is protected.
Yeah.
Maybe that's what it looks like. I know in a lot of the different airline setups, they've got some pretty considerable life insurance that's already paid for by the company. So you might not need an additional coverage for you personally. Maybe you can build these IBC policies out by just covering your wife. Now you've got to be careful on where that goes, right? Because you can't just go to the insurance shop and say, I want $4 million on my wife, and they go, well, you're not covered because you're the primary breadwinner of the company, of the household, right? There's going to be some balance there. That's where you talk to a practitioner and really hash that out. But the main part of this is, of those 3 entities of the life insurance contract, we need to build each one of those out properly.
That's correct. And one thing that you said that I wanted to hit on that I think is so critically important, especially for airline pilots and other people who've got group term insurance with their companies. Hey, I got $1 million. I got $2 million of group term insurance. Wonderful. What happens the day you leave the property? That is gone. Now, there are a couple airlines that have got this, universal life, variable life products that you can buy.
To become really expensive after you retire.
I guarantee, as close as I can come to say guarantee, because of Nelson, and he showed me the math on this, what happens with a variable life and a universal life, they're very, very similar. A universal life just is annual renewable term, which gets more and more expensive every single year. And then it's supported by a investment account, which is basically a interest-bearing account of some sort, which is tied to the company and their performance. And so that gains, and those gains are offsetting the dollars that they're making in that side portfolio are paying for the annual renewable term. The variable might be in mutual funds. So you could pick the S&P 500, and as long as the S&P 500 is on a tear, you get a participation rate there, and that participation offsets that annual renewable term. The whole problem with these things is the most expensive insurance in the world is what, Jared?
The annual renewable term.
Yeah, your term insurance. It's cheap, especially when it's level term. But I'll tell you what, I had $1 million term when my kids were little. I had $1 million term policy in case something happened to me. And it was like $800 a year. Pretty cheap.
Sure.
For 20 years.
Yep.
Do you know what it was the following year? It was $16,000.
Oh, wow. I was going to say 10x. That's 20x.
Yeah. And it went up from there. And so unless you are terminally ill, there's no way you're going to keep these contracts.
Sure.
And you get to the point where the cost to maintain that term contract exceeds the death benefit, and so they implode.
Sure.
It's not going to happen.
Well, not to mention it violates what we were just talking about earlier today, which was you just talked about an investment style portfolio linked to insurance.
Yeah.
Why would you ever mix the two?
E.F. Hutton. Oh, you remember E.F. Hutton? When E.F. Hutton talks, people listen. You probably don't remember that.
I don't remember that.
That was a commercial when I was a kid.
Sorry.
Guess where they're at today?
Where?
Out of business. They went bankrupt.
Sure.
So do you want to listen to that company? When E.F. Hutton talks, people listen? Or do you want to do this the right way?
The fact that I don't even know what E.F. Hutton is, I don't know if that's an age show or I don't know if that's a generational show, but yeah. It's just the idea, though. Why would you link an investment to where your capital sits in this style? Like, if you're going to mix up investment and insurance, wow, I mean, that just seems like a really risky move. The whole purpose of having a whole life policy is so that I transfer the risk to the insurance company.
Bingo.
I'm transferring the risk of my life that they're going to cover that whenever that happens. Is it tomorrow or is it 50 years from now? I'm not sure, but they have accepted all of that risk.
That's exactly right. And that's what's not in place with a universal life or a variable life. Those are quote unquote permanent insurance, but I'm here to tell you they're not.
Yep.
Because they rely on that side account to fund the annual renewable term.
Sure.
And so long as you're willing to pay the annual renewable term, yeah, they'll be there. But why would you do that when you're looking at the long haul, when you can buy a dividend-paying whole life insurance contract, which is built specifically to carry you through your entire life?
That's right.
Guaranteed.
Yep.
It will not go down in value. It will not default as long as you pay your premiums along the way. They are guaranteeing all the risk, as you said, was with a life insurance company. Whereas the variable and the universal life,
they're transferring it to you.
Yeah,
that's
your
right.
Premium is at risk. Your death benefit is risk. The cash values, or all three, are at risk.
I'll even go out on a limb here and say that if you're speaking with someone, it doesn't matter what company they're serving. If they're talking about insurance and your death benefit is not increasing every single year, are you looking at the right product? I understand that term might be a good, stopgap for some people. I'm not saying that's a bad thing or a bad product.
Yeah.
But if you're looking at a universal product or a variable product with a very similar or a level payout in a death benefit, you're not doing it right.
There's only one exception to that, and first of all, you're spot on. You're exactly right. There is a product out there that we do utilize. It's the EBIR, which this one company does have. And what they do is this gets into the weeds a little bit, but what it does is it allows people to convert the required term to keep it from mecking into permanent insurance. And so as it's going through that process and winding down the term, it's buying permanent insurance, but the death benefit doesn't go down.
That's right.
And that's one of the big gotchas on some of the other term policies, which are for a period of time, 7-year or 10 or 20-year term. You'll look at the illustration on those darn things and say they need $200,000 or $300,000 or $400,000 of level term to keep the contract from becoming a mech. You'll see in the far right illustration column where you may have $500,000 of death benefit, and then after year 7 going to 8, boom, it drops to $300,000. Why? And these are conversations, of course, we have with clients. But
that's right.
The reason is because the term drops off.
Yep.
With the EBIR, that doesn't happen, which is pretty cool. That's the only other exception to that rule.
That is really cool. I think it might be an appropriate time to just touch on MEC. I know we haven't really talked about that in this podcast, and I know we're probably going to devote an entire podcast to it. But
good thought.
Let me just tee it up for you, and I want to hear your thoughts. MEC is short for Modified Endowment Contract. Yep. It is really the Achilles heel of IBC. We do not want to create you a policy that has a MEC built into it. Some folks will do that where they not practitioners, but some other life insurance folks are willing to say, sure, no problem if that thing mechs at age 60 or age 65, fill in the blank. That is not our goal. It's almost our crutch to not build you a contract that mechs. The specific reason why is the tax implications of a mech.
Exactly right.
Do you want to expound on that a little? And where did I miss on that?
Sure. And just on the front end of it, a mech is not a bad thing in and of itself.
Sure.
If you're estate planning.
Right.
So say somebody's they want to leave, Billy a bunch of money after they're gone,
Yep.
and they're never going to touch that money. You can do a single premium, boom, dump it in. It will mech day one. And the difference between a regular life insurance contract and a mech is the products are identical. It's just the tax treatment.
Sure.
That's the real difference. So when you have a modified endowment contract, and when you're practicing infinite banking, you do not want a modified endowment contract, and so you're gonna tend to build this thing with using base and paid up additions to drive the cash values inside the contract up to the you want to snuggle up, as Nelson would say, into the modified endowment contract line. You don't want to cross it. But the significant difference between them is when you have an IBC built contract that is not a MEC, it's first in, first out. Meaning, if I put $10,000 into a contract and I'm going to pull some money out for a loan, for instance, there is no taxable consequence. It doesn't even register. You don't even have to tell anybody about it.
Right.
However, if you MEC that contract by $1 will do it, and once a MEC, always a MEC, now that inverts everything. It treats it just like an annuity, which means it's first in, last out. So all of the gain that you're getting inside this contract must come out first, which means it's taxable.
Sure.
So if you pull out money, you got to pay the taxes on it. We don't want that as practitioners.
And so to dispel maybe a myth or two out there, a MEC doesn't mean that your cost of insurance increases. It doesn't mean that your cost of premium increases. No. There's no true change to the product that is used to build the IBC contract, yet the tax implications are huge.
They are.
And since we're using this as we just said your need for capital is greater while you're alive than your need for a death benefit.
That's exactly right.
Well, we plan to use that capital that we build up into these policies. We don't want the funds that come out to be taxed.
Amen.
So am I saying that right?
No, you are.
Sure.
You are. And if properly done, they talk about these life insurance contracts as tax-deferred. If you do it correctly, it's tax-free.
That's right.
But it can be tax-deferred because basis comes out first. And after you hit basis, there's a couple of considerations, but we'll get into those variables later. But the meat and potatoes of this whole thing is you can conduct your entire banking business life with infinite banking contracts and never pay a dime in taxes on them.
The other thing to maybe mention, and kind of as we talk about this whole, this spectrum of life insurance that's available.
Yes.
I know we talked about term. You said a 20-year term to protect your family when you were younger.
Right.
To bring that into the IBC piece, we are usually including term in these policies, correct?
We are.
Right. So maybe a quick touch on what that looks like and how it's different from your standard term that you'd buy off the street.
Right. When you're buying term, you're buying strictly death benefit. There's no cash value. It's a vanishing asset. All right. And you got to die.
Sure, you're going to.
So if you don't die, at the end of it,
you got to die for it to pay. That's what you're saying. Makes sense.
For it to pay.
Yep.
Yeah. So you go 20. In my case, I go 20 years. I go 20 years and a day. It's gone.
Yep.
And all that money that I paid in is gone.
But as we said, in kind of this policy design conversation of building the right framework, why do we have to use term in an infinite banking policy?
Okay.
Why does that end up showing up there?
Well, because it has to do with the modified endowment contract.
Perfect.
Right?
Yep.
So when if you can only put in so many dollars into it, and if you really want to know the details, I can water your eyes and put you to sleep.
But you're meaning the 7-year pay test.
Yes.
Correct. Okay.
It's gotta meet the 7-year pay test. And so the thing about it is what people don't understand is when you go beyond a certain value, let's say it costs $10,000 for X number of dollars of insurance for somebody who's 35 years old, male and healthy. Let's just, for the sake of argument, a survey of insurance companies says that number is $10,000. The IRS basically says, okay, there's your number. If you go over that number, if it's $10,000 a year, that's $70,000. If you put in $70,000 plus one more dollar, it becomes a mech.
Yeah, so we were talking about a mech earlier. This is kind of bringing back around how it happens if it exceeds that 7-year pay test.
Yes, but what happens though is as you do this, it's because it's predicated off of the amount of death benefit. And
so the cost of insurance. So if you can increase the cost of insurance.
Bingo.
Yep.
So if you drive up the death benefit, you can actually put more into the contract.
Makes sense.
And that's why you do it. And so you can get a pretty crazy contract where you do, well, getting into the weeds a little bit, your 10% base, 90% PUA, and a boatload of term. You can get a monster amount of cash into this thing. Here is the danger. Any contract with PUA, you talk to anybody, any contract can mech. It can. Yep. The probability is very, very low. But here's the deal. Every time you get a dividend on the base of your contract, that will not ever mech a contract. However, if you've got PUA attached to it, there is a calculation that the insurance companies run every single time. And they don't do it out. So let's say you've got a policy that's built out with PUA paying for 10 years. They must run that not to 10 years. They got to run that to the duration of the contract. And if at any point during that period it's going to mech, at that point your contract will become a mech. They will tell you about it, and there's not a darn thing you can do about it. So that's the big caveat and the big danger you have to be aware of is when you overfund a contract, have a balance. Don't just put in a ton of PUA with no base, because you could find yourself in a very difficult situation 15 years down the road that you didn't plan on, and all of a sudden you've got a mech contract.
And maybe to pull back the fear factor a little on that, if this is very prevalent when you're building these 90-10 style contracts,
exactly right?
So
we don't go near that.
Right. If you're a 60-40 type of a guy when you're building these out, your chances of hitting that are not good.
No.
But when you're just running that line, and when you're running that engine at red line, that's when it has the possibility, at no fault of your own, to potentially mech.
Yeah.
And it's why you want to be with a practitioner that's going to understand these concepts to help you along with the process.
And you as the policy owner should understand this. Yep. What Jared and I do every time we go through these things, we walk through the contract, with the client, make sure they understand the parts of the contract. And one of the things you can do to see how your contract is performing is keep your illustration that you initially got. It should be inside the binder of your policy was delivered to you, and then take your annual statement and look at that. And Jared and I would be happy to review these for anybody, but you can tell how your contract is performing. And
I think I'll add one quick story on that, and it's a recent client, and what they ended up doing was they were a little hesitant on the amount that would pour in as a young family. Yeah. They were hesitant on what they could give and make it meaningful, but also manageable.
Right.
So they were just hesitant about the amount. Let's just say that.
Right.
But they've got a young family.
Right.
And so when they started this policy with me, when we designed this for them, they ended up building a 15-year term into the policy. Yep. That was a big amount. It was just short of $1 million.
Right.
Now, they don't have the $1 million in base policy on the whole life.
Right.
But they've got $1 million, what we use is convertible term.
Right.
That's the other thing that's a little different about the term that you're going to buy off the street. So he's got almost $1 million in convertible term. As a 33-year-old guy, locking in a preferred health rating right now, that at any time over the next 15 years, if he wants to convert any of that just short of $1 million value into a whole life policy, he can do so at the preferred non-tobacco rating. That flexibility alone, I mean, his family is protected in a huge way. God forbid something happens. He has a very considerable amount that would take care of his wife, his kids, and anything that they need for the next 20 years. Yet, he also is building flexibility in his IBC account.
Yes.
That there's cash value growing every single year. And if he wants to open another branch of his bank, so to speak,
right,
he has the option to do so. So kind of a cool scenario on when you can allow yourself to step back and just think of something a little different way. Try to, maybe twist the lens a little bit and be like, man, I don't understand this, but I want to dig into it. I want to find out about it. That was how I did it. Yeah. I didn't get it at first either.
Well, usually you got to go to 7 years. That's usually the cutoff. You're because it's a 7-year rule. But by going to 15 years, you might not need 15 to prevent it from meching. But what you've done is exactly what you just said. And so a little bit a little bit of forethought, a little bit of forward planning, you've locked in a wonderful solution for somebody. What if they lost that rating? What if they needed that additional insurance? Earlier podcast, I talked about that client whose father bought the life insurance for her and had 3 purchase gates, 3 purchase years that they exercised. Not insurable, zero insurability. But
yeah, and to back up what you're saying there, you're saying you only typically need 7 years in that IBC contract. Maybe someone's 45, 50 years old. Their kids are almost out of the house. They don't need that 15 years of coverage. Great. We'll talk with you and find out what your situation is, and we'll build a 7 in there that allows you to not make the contract. And when the 7's done, you've converted it, and maybe you haven't. Yeah. It's your choice. You get the option there.
You know, it's funny, Jared. I've talked to several people who've come to me and they've said, gosh, I wish I knew this before I did this policy. Yep. And maybe we can do a podcast on what's called 1035 exchanges.
Sure.
You know, there's a lot of people who bought things not knowing exactly what they were buying, and it was sold to them not really delivering a product. When we, as you know, we get to know our clients pretty well. Everybody that we do business with knows what they're getting and the power of infinite banking. And I always tell people that, hey, I'm at your service.
But in order to know what you're getting, you need to know part of the product as well. This is not like your tax accountant where you show up on April 1st, give us your tax statement, and then on April 15th we've got an output for you. We're going to be able to talk with you throughout the year and help you problem solve. We won't necessarily have the answers all the time, but we're there for the discussion year round on what this looks like and what you've created, because you need to be educated on this as well. As the ideas pop up, as the ideas flow, you literally have infinite amount of opportunity on what you can do with the capital.
Yeah. Well, you need to know what your income and expenses are on a monthly basis. You absolutely need to do a budget for yourself. You need to read Nelson's book. You need to create a budget for yourself if you haven't done this. You need to know what your income and expenses look like for the year, and you also need to know what your assets and liabilities look like. These are the things that we look at. I love a tax return because it tells everything about you. Mm-hmm. So you go into these numbers and you figure out, okay, where can I find money? What do we have to spend money on? What do we not have to spend money? Kind of like an Elon Musk approach.
Sure, right.
He's been pretty successful, finding billions and billions of dollars. Yep. I don't know that I can find that much, but I'm confident that Jared and I can find an awful lot of money that you're not even looking at. You didn't have to do anything different in your life, but now you've got the power of an infinite banking contract working for you, growing year after year, and your emergency money. Everybody should have an emergency stash of cash that they can tap if they have to. But guess what? You can make money do 2, 3, 4, 5, 10 things for you inside of a life insurance contract. It's a very, very powerful instrument that very few people truly understand.
Sure. Well, I guess that kind of brings us to a close here for episode 4.
Okay.
Thanks for getting together, John. Always a pleasure to be with you.
Jared, thank you.
Anything to close us out today?
Should I go after that guy who booted my car, or should I just let it go?
Oh, man, if it was me, I would let it go, but I'm not going to judge if you do.
Oh, my gosh. Yeah, there's something else. There's something else. But anyway, no, I think we've satisfied this part of the discussion, this part of the book. Thank you.
Thanks, John. So tune in next time. Absolutely. Tune in next time where we'll continue to go through Nelson Nash's book, Becoming Your Own Banker, where we explore more ideas about the infinite banking concept.
Wonderful.
Thanks,
all right.
John.
Thank you,
See you next
Jared.
time.
Okay, bye. We'd like to thank you for tuning in to today's episode of Creating Tailwinds podcast with your hosts, John and Jared. As always, we welcome your questions and critiques. You can reach us through the Contact Us tab at flightpathfinancial.com. Remember, it's all about how you think. As Nelson Nash has said about infinite banking, give it your close attention, and it can make a radical improvement in your financial future.